Thanks to our friends at The Motley Fool, we get to make these videos because of our partnership. If you're looking for some great stock ideas, go to our link, fool.com/the smattering, and The Fool is going to give you their 10 best stocks to buy right now.
Let's move over to Lyft. Q3 revenue, $1.05 billion. Net loss, $422 million compared to $99.7 million a year ago. My goodness.
Yep, substantial. Gross margin, gross profit increased slightly, increased 2%. Now again, revenue increased 22%. Gross profit dollars increased 2%, meaning gross margin came down. So revenue minus cost of goods sold, that's your gross profit dollars. That came down substantially. So that's a challenge. What I really want to look at, and I think it's so important in these businesses right now, is to look at their operating results and to look at a statement of cash flows. So I'm gonna go straight to that in this report here. So let's start here. Net loss, $422 million, like Travis talked about, but it's a $290 million operating loss, right? And we've seen an acceleration of that year over year, and essentially about the same operating loss as it generated year over year for the first 3 quarters of the year, right? So that's important. Again, the losses continue. Now let's talk about losses on a cash flows basis. This is really important. And again, lost in the first 9 months of the year, lost $75.5 million a year ago. That's pushing $204 million this year, right? So continues to lose money. I'm going to move up here to the balance sheet, because if you're losing that much money, you need to know how much money Lyft has in the bank. Has the short-term investments here. This is basically cash equivalents like treasuries and things like that are ultra safe. So you're looking at $1.64 billion in cash, which is a substantial amount of cash. Now let's
add in
figure
what
out
they have
working
on the in actual cash and equivalents. You're talking $1.8 billion.
About $1.8 billion, right? So let's figure out working capital. So that's current assets, meaning things that you can quickly turn into cash, minus current liabilities, which is stuff that you owe somebody money for in the next 4 quarters. And we've got $2.5 billion in current assets, $2.7 billion in current liabilities. Travis, correct me if I'm wrong, but they ain't got no working capital.
Yeah, they're in a tough spot. One of the things I'm watching this quarter, especially in the tech space, is what's happening with operating expenses. Like, are you continuing to expand headcount as we clearly head into some sort of a recession, slowdown in growth, whatever it may be? This is one of those businesses where you look at their numbers, and even just at a really high level, you kind of have to scratch your head and say, what do they need to do to make money? Like, right. They would have to raise their prices by 50% to get to break even.
I think this is important because you think about Lyft versus like Uber. And I think people a lot of times immediately just like, okay, well, one's Coke and one's Pepsi. Well, okay, PepsiCo also has all the Frito-Lay products, right?
Right.
And Uber also has like Uber Eats. It has these other channels.
Makes more money on
driving
that.
revenue, and it seems like they're generating really good operating margins too, right?
Mm-hmm.
I think that's important, right? Because you look at Lyft and what it's doing, and there's real questions about how does it. Can you grow into this? It doesn't seem like it. They just had their best quarter ever in terms of revenue, right? Sequential growth in riders, 6% growth year over year in riders, and the losses are compounding. And when your working capital is negative because you owe more in the next year than you have in current assets.
Well, and then you have the inflation piece of it, and there are multiple angles that can hurt Lyft. One, drivers could just demand more pay. If the cost of gasoline has come down a little bit, but it's still pretty elevated from a few years ago. So it's more costly to operate. You know, vehicles are expensive. Interest rates are going up. So buying a new vehicle is going to be expensive. I know Uber has long had programs to help drivers buy vehicles or lease vehicles. Well, that vehicle suddenly becomes more expensive when the interest rate on the vehicle is 7, 8, 9% as opposed to 2% or 0% maybe like it was a year ago. So I just, again, my question is, can they increase? What happens to the business if you increase prices 50% or 100%? And that's the kind of stress test I'm trying to think about more and more with a lot of these companies, because you're right. Fundamentally, there's no way that this business can survive as is. I think that's just the bottom line.
The math says they can't, right? And of course, there are other avenues to get capital. But in this environment, let's be honest, they're not going to be very shareholder friendly. Mm-hmm. And you would imagine that it's creditors want to keep this a going interest. And I'm not calling for, and I don't think you are, Travis, either, necessarily calling for Lyft to be filing bankruptcy anytime soon. But thinking about
they've got to figure
out where its financial results are, think about where its cash flows are, think about where its balance sheet is, thinking about all of the material risks in the economy that could undermine its efforts to drive better margins. You know what I say, Travis? I put it in the too hard pile right now. I think there's too many questions and I can't figure out those answers. I'm not interested in Lyft because of those things.